In the previous video, we learnt about the current MCX exercise mechanism, ITM rules for calls and puts, what is exercise and devolvement, and meaning of contrary instructions. In this video, we will learn more about devolvement with examples of gold call option and copper put option. Also, we will see why devolvement matters. Gold call devolvement. If no contrary instruction is given, the long gold call is exercised.
So the option now converts into a futures position.
Exactly. The long call holder receives the cash difference between the settlement price and the strike price as per the settlement schedule. In our example, the cash difference is Rs 2 lakhs per lot. At the same time, the option position devolves into a futures position. The long call holder receives a long gold futures position. This devolved futures position is considered to be opened at the strike price of Rs 1,40,000. The trader must now manage the futures position.
What changes once a trader has a futures position?
As we have covered in lessons earlier, a futures position means 1. There will be futures margin requirements which were not there for the long call. On one lot gold futures priced at Rs 1,40,000, assuming the margin is 10% of the exposure, the margin will be 1,40,000 into 100 quotation units into 10% equals Rs 14 lakhs. 2. There will be daily MTM, so the participant needs to have enough cash in the account. Even a 1% downside in gold will require MTM of 1,40,000 into 100 quotation units into 1% equal to Rs 1,40,000. 3. If the futures devolve close to the staggered delivery period, the long futures position may attract extra margins of 8.34% a day. Let me explain in slightly more detail. In some commodities like copper, the option's expiry date is 5 working days prior to the expiry date of the futures, and the staggered delivery period kicks in 3 working days before expiry, including expiry. To take an example, August 24, 2026 is the options expiry. August 31st, 2026 is the futures expiry. The staggered delivery period starts from August 27th. Hence, if a trader has a devolved futures position, the trader has only 2 days to square off the futures position. Otherwise, 8.34% additional margin will kick in on a daily basis from August 27th. Both long and short positions will attract staggered delivery period margins.
I am getting it now. Can you summarize all of this?
Definitely, Ayush. Gold call summary table. So for the gold call option, we can summarize our example in the table shown. Gold settlement price, status, exercise, cash difference for long call, devolvement. If the settlement price is below the strike, it expires worthless. If the settlement price is equal to the strike, it also expires worthless. If the settlement price is above the strike, it is in the money and is automatically exercised unless the long call holder gives a contrary instruction. If exercised, the long call becomes a long futures position. Example 2. Copper put option. Now let us take the second example. Suppose a trader holds a copper put option with a strike of Rs 1,300 per kg. Copper is quoted in rupees per kg. The lot size is 2,500 kg. The tick size of copper is 5 paisa. Every 5 paisa movement in copper affects one lot by 0.05 into 2,500 equal to Rs 125. And every Rs 1 movement in copper affects one lot by Rs 1 into 2,500 equal to Rs 2,500. Let us look at the following final settlement price scenarios. Copper put strike price equal to Rs 1,300. Final settlement price, status. For a put option, the option is in the money only if the settlement price is below the strike price. So if copper futures settle at Rs 1,320, the put option is out of the money.
Why?
Because the put buyer has the right to benefit from selling at rupees 1300, but the market settlement price is rupees 1320. There is no intrinsic value, so the put option expires worthless. No exercise happens, no futures position is created. The put buyer loses the premium paid.
So, the put seller keeps the premium received subject to other charges and obligations.
Correct. Now, if copper settles exactly at rupees 1300, the put option is also treated as out of the money and expires worthless. Now suppose copper futures settle at rupees 1275 on expiry. The copper put strike price is rupees 1300. Since the settlement price is below the strike price, the put option is in the money. The intrinsic value is rupees 1300 minus rupees 1275, which equals rupees 25 per kg. Since one lot is 2500 kg, the cash difference is rupees 25 multiplied by 2500, which equals rupees 62,500 per lot. If no contrary instruction is submitted by the long put holder, the option is automatically exercised.
Okay, I have understood it now.
Copper put devolvement. If copper put is ITM and no contrary instruction is given, when a copper put option is exercised, the long put holder receives the cash difference between the strike price and the settlement price as per the settlement schedule. In our example, the cash difference is rupees 62,500 per lot. The option then devolves into the underlying copper futures contract.
So, the futures position starts at the option strike price?
That's right. A long copper put becomes a short copper futures position. These futures positions are considered to be opened at the strike price of rupees 1300. So after expiry, the trader must manage the futures position. This will involve management of margins, MTM and staggered delivery period requirements. Copper put summary table. So for the copper put option, we can summarize our example in the table shown. Copper settlement price, status, exercise, cash difference for long put, devolvement. If the settlement price is above the strike, it expires worthless. If the settlement price is equal to the strike, it also expires worthless. If the settlement price is below the strike, the put option is in the money and is automatically exercised unless the long holder gives a contrary instruction. If exercised, the long put becomes a short futures position.
Great. The table makes it easy to remember and recall.
Why does devolvement matter?
Why does devolvement matter so much?
Devolvement matters because after expiry, trader may suddenly have a futures position. A futures position requires margin. It also creates mark-to-market profit and loss. And depending on the commodity and expiry cycle, the trader may also need to be aware of delivery period obligations.
Okay, so after devolvement, traders need to keep all these things in mind.
Yes, and after options devolvement to futures, open positions may exceed permissible futures position limits, and such excess positions must be reduced within 2 trading days. So traders should not wait until expiry without understanding what futures position they may receive.
I understood this. It's important for traders to know the result of expiry before they decide to hold an option until expiry.
You're absolutely correct. Let's do a final recap. Final recap.
Can we quickly review the entire process?
Yes, let us summarize. On MCX, options on commodity futures follow an automatic exercise mechanism. If an option is out of the money, it expires worthless.
So, no futures position is created.
Correct. If the settlement price is exactly equal to the strike price, it is also treated as out of the money. If an option is in the money, it is automatically exercised unless the long holder gives a contrary instruction. When exercised, the option devolves into the underlying futures contract. A long call becomes long futures. A long put becomes short futures. A short call becomes short futures and a short put becomes long futures.
So, every exercise option has a corresponding futures position?
Exactly. This is why every MCX options trader must understand not just payoff but also exercise, contrary instruction and devolvement before holding a commodity option until expiry.